Hello friends, welcome back to our weekly update on tax and corporate laws for the week ended 15 November 2025. Let's begin with the key developments under the Income Tax Act. The Bombay High Court, in the case of International Resources for Fairer Trade versus Union of India, delivered an important judgment on condonation of delay for charitable trusts. The court held that when a trust has consistently filed its returns and Form 10B on time in earlier years, and the delay for the relevant year occurred only because of genuine reliance on a chartered accountant, such delay must be condoned. This reinforces that procedural lapses caused by professional oversight should not defeat genuine charitable activities. Moving ahead, the Mumbai Tribunal in Supertex Industries Limited versus DCI Key clarified the applicability of Section 1515JB. It held that once the company's net worth becomes positive and it comes out of the purview of SICA, it cannot claim exemption from MAT under Section 1515JB. Essentially, revival from sickness means returning to normal tax obligations. Another interesting ruling came from the Mumbai Tribunal in the case of Naik & Co. The assessee, a law firm, had received payments net of TDS and claimed full TDS credit after offering the entire gross income to tax. Even though the TDS did not reflect in Form 26AS, the tribunal held that genuine TDS credit cannot be denied simply due to system mismatch when the income is correctly offered to tax. In another case, DCIT versus Neeru Dhiren Shah, the tribunal strongly criticized additions based merely on assumptions. Here, the assessing officer added income under Section 69A, alleging that the assessee received extra cash over and above the sale consideration of property. The only so-called evidence was a WhatsApp chat between the buyer's son and his accountant, containing an Excel working of rough values. Since the chat did not mention the assessee or the transaction and lacked any corroborative proof, the tribunal deleted the addition, stating that assessments cannot rely on conjecture. Lastly, the Bombay High Court in St. Anne's School versus CIT exemptions held that delay in filing Form 10 for accumulation under Section 11(2) should be condoned when the trustees had approved accumulation in physical form and the delay occurred only due to transition to the new e-filing system. The court noted that rejecting condonation without appreciating reasonable cause was improper. Now, let us turn to updates under GST law. The Gujarat High Court delivered an important ruling on interest liability. It held that when tax is voluntarily deposited through DRC-03 into the cash ledger before filing GSTR 3B, and the amount is already credited to the government, the liability stands discharged on the date of deposit. The subsequent debit in the return is only an accounting formality, and therefore interest cannot be imposed for the period between deposit and return filing. This protects taxpayers from unnecessary interest disputes. The Allahabad High Court clarified another significant issue. It held that when excess or unaccounted stock is found during a survey, authorities must use the statutory provisions under Sections 35, 6, 73, or 74 for tax determination and cannot directly invoke confiscation under Section 130. This ensures that confiscation is not misused where proper assessment provisions exist. The Madras High Court, in a case related to natural justice, held that when a DRC-01 notice was only uploaded on the portal and went unnoticed, and the taxpayer produced evidence showing payment of the disputed tax through the electronic cash ledger, the assessment order must be quashed and remitted for fresh adjudication. The court allowed the taxpayer to file submissions and directed proper verification of payments. Similarly, the Delhi High Court set aside ex parte assessment orders where taxpayers could not file replies due to lack of effective communication. The court emphasized that even in GST, principles of natural justice cannot be diluted. Lastly, the Gujarat High Court ruled that when a rectification order passed in August 2024 was not visible on the portal and the taxpayer first received actual communication in November 2024, the limitation period for appeal should start from the date of actual communication. This made the appeal filed in January 2025 perfectly within time, and required the authorities to reconsider the appeal on merits. Now coming to important developments under corporate and other allied laws, the Supreme Court in the case of K. Murali Krishna versus Deputy Director, Directorate of Enforcement, refused to discharge a petitioner who claimed he was wrongly implicated in a money laundering case. Even though he argued that he only helped in filling account opening forms and check leaves for a co-accused, the court observed that he knowingly assisted in activities connected to the proceeds of crime. Hence, the trial court was right in rejecting the discharge petition. The NCLAT, New Delhi, delivered a significant ruling on fraudulent related party transactions. It held that when a director or KMP of a corporate debtor sells shares of a related party to himself at a substantial loss, causing depletion of assets, Section 66(1) of the Insolvency and Bankruptcy Code applies independently, without any look-back period restriction. The director can be directed to contribute the loss amount with interest to the corporate debtor. This strengthens accountability against misuse of position. Finally, the NCLT Ahmedabad observed that disputes relating to transfer of shares, especially involving family arrangements and contested title, are civil in nature and cannot be decided summarily under Section 59. Such matters require detailed examination by appropriate civil forums. That brings us to the end of this week's update on tax and corporate laws. If you found this useful, stay tuned for more such weekly insights.